You've just finished college. You've moved to New York City. Your goal is to be a novelist, but to survive, in the meantime, you are working as a full-time waitress. If you could only squirrel away a small amount of money each month from your waitress job, your waiting job, what should you put it into?
The way the video just stopped short is exactly how I felt when I saw my uncle's new video. I was so surprised. I asked him, "Did you make this video for me?" You could almost argue he's talking about me, a 25-year-old teacher who's just starting to get out of debt, but he said he just wanted to give people some honest advice. So I started spreading his word to my friends, and they really appreciated it. Since then, I joined Powers with my uncle to bring you a video series that we like to call Uncle Svi Says. We hope you enjoy, and even more importantly, that you learn something. In this edition of Uncle Svi Says, we will take you on the road to worry-free investing. The basis for today's video comes from Uncle Svi's cleverly titled book, Worry-Free Investing. So without further ado, fasten your seatbelts, keep all arms and legs inside the vehicle, and let's begin our road trip. Picking up where we left off in the opening video, the first question is, what should you do with your money? Well, there's already some good advice out there, namely from the Securities and Exchange Commission, or commonly called the SEC. On their website, investors.gov, they created this excellent roadmap to saving and investing. So let's make a little room, and we'll bring that up, and there you go. So let's explore this map together. In the first step, you gotta make some goals. In another video, we'll actually help you set these goals, but for now you can just make a list, or even use the SEC website to help you out. Next, they explain you should figure out your finances. We think this is probably something you should do before setting goals, but the point is you should definitely know how much you own and how much you owe, so we're okay with this as step 2. In step 3, they show you how saving, even in small amounts, can add up substantially. Now this isn't really a step per se, but it's a good point, so we're cool with it. In step 4, they address the opening in our video that you gotta pay off your debt, right? Probably not a good idea to start moving money around when you don't really have that money to move. So once you accomplish this, then we can move to step 5. Now this is where things start to get a little tricky, and we need to go a little more in depth on this one. But if it's alright with you, I'd like to add a little life to this roadmap. So let's start with adding some color. Much better. And we need a tour guide, don't we? So let's get our government driver, and let's follow him to step 5. The SEC calls step 5 Save for a Rainy Day. This sounds like great advice, so let's see what they mean. Savings are usually put into safe places that allow you access to your money at any time. Examples include savings accounts, checking accounts, and certificates of deposit. So it sounds like they're saying, put some money in a bank. Let's keep reading. But how safe is a savings account if the interest it earns doesn't keep up with inflation? Whoa, back up. My money isn't always safe in a bank? I think we should learn a little more about this inflation thing. To help us answer this question, let's have the group Investopedia help explain inflation to us.
Inflation is the increase in prices of goods or services over time. Dan just got paid and needs to buy groceries. Dan heads to the grocery store and loads up his cart with the items that he needs. These items cost Dan a total of $100. A year later, Dan returns to the grocery store with $100 to purchase the same items. However, now the same items cost $105 and Dan is forced to remove an item from his cart. Dan has experienced the effects of a 5% inflation rate. Dan must pay $5 extra to purchase the same items that cost $100 only a year ago. Inflation leads to higher prices and lower purchasing power.
Although Investopedia does an excellent job illustrating inflation, let's quickly review to make sure we get it. Inflation is when there's a rise in prices, and this makes your money worth less. This concept should intuitively make sense, but let's use a historical example to make sure. Let's look at $100 again. Today, you're lucky if you can get a decent pair of jeans for $100. But check this out. 50 years ago, you can get not one, but 2 suits and still have money left over. No joke, Google it. And if you want more examples like this, just ask your grandparents how much things cost back in their day. I know, you're trying to hold in that laugh, but go ahead, no one's judging you. Back to the SEC roadmap to saving and investing. Step 6 is all about trying to keep your money safe since we just learned the potential dangers of keeping your money in the bank. So the SEC tries to solve this problem by telling you to invest. But there's something they say about investing that doesn't feel right. When investing, you have a greater chance of losing your money than when you save. You could lose your principal, which is the amount you've invested. So hopefully your portfolio goes up. But if it starts to go down, well, you might be out of luck and out of all that money you just invested. The SEC isn't wrong about this basic investing principle. I mean, all of investing is built on the idea that you can make more money, but you have to take a greater risk. But right here, the image shows just what the SEC was saying, that all investments at least have some risk. If only there was an investment here instead. Is there anyone here that can help us, please?
So today I'm very pleased to announce that for the very first time, families will be able to buy new inflation-protected government bonds. These savings bonds offer true inflation insurance, helping middle-income families save for retirement and invest in their children's education without ever having to worry that their savings might be undercut by future inflation.
Definitely not the most exciting delivery, but Al Gore just turned the whole investing world upside down when he made this announcement. Let's see when that was. Thanks to the Treasury Department, which created a beautiful timeline showing all the savings bonds they offer, we can see that Al Gore was introducing Series I saving bonds in 1998. Let's learn a little more about I-bonds from Uncle Svi.
I strongly recommend U.S. Series I savings bonds, which are inflation-protected savings bonds. They have an ultimate maturity of 30 years, so if you don't touch the money, it's accumulating for 30 years and it's there for retirement for your old age. But after the first year that you've had money in the account, you can take it out at any time. And it's fully protected against inflation. So whatever the rate of inflation is, you're covered. In addition to that, there may be, although right now there isn't because interest rates are so low, there may be some interest that you earn above and beyond inflation. That's called the fixed rate. Amazingly, and for a host of reasons, not good reasons, I'm afraid, the government has not done a very good job of making young people like you aware of the existence of Series I savings bonds, because this is the ideal investment for money that you don't want to necessarily lock up for retirement. But you know that if you leave it in there, you're fully protected against inflation for 30 years, as long as you think the U.S. Treasury is not going to go broke, which I suppose is a possibility, but it's not as big a risk as what can happen to your money if you invest it in the stock market.
Not bad, Uncle Svi, but I'm a visual learner, so let's try to add a picture to your fancy production. With I-bonds, you gain interest every month, but this interest isn't a simple percentage. Since it's made up of different components, it's called a composite rate. So what is it a composite of? First is a fixed rate. This is a percentage set by the government. Then this fixed rate is added to the inflation rate. And when you put these two rates together, then you get a nice percentage. Now an astute student of finance would point out a negative possibility. They would say, wait a minute, Uncle Svi, inflation isn't always positive. Sometimes there are points of deflation where the inflation rate is actually negative. And you'd be absolutely right. Surprisingly though, the government actually foresaw this problem. Let's see how they account for it. To prevent you from losing money, let's look at what the Treasury says about the composite rate. They acknowledge that deflation could possibly decrease your composite rate, and it can even make the composite rate less than the fixed rate. But thankfully, if deflation was negative enough to take away more than the fixed rate, the Treasury doesn't allow this, and they would just set your composite rate to 0. So in short, you can stop gaining money, but you can never lose purchasing power. And this is something you can only get with I-bonds. Even though the SEC warns people of inflation, most investment brokers would say, inflation, forget about it. Remember our helpers at Investopedia? Here's what they say about inflation. The running joke on Wall Street is that it's easier to sell an air conditioner in the dead of winter than it is to convince investors they need protection from inflation. Inflation has been so low in recent years that it hasn't been much of an issue. So we should believe them, right? No. Here at Uncle Svi Says, we're trying to bring a scientific approach to investing. So what do we need? You guessed it, data. Here is the inflation data from 1914 to 2012. We think this looks really random. But as you heard, a lot of experts say that inflation has been low in recent years. They're focusing on this area right here. But let's compare it to this area over here. You don't have to look too closely to see that these two 20-year periods look pretty similar. In fact, we even use the same exact circle on the chart. So inflation has been low before, but right smack in the middle of these two periods is this crazy time during the 70s and 80s. So even though that we agree that inflation has overall decreased in the last 50 years, to say that we have it completely under control and that it will stay this way, well, we think that's a very dangerous prediction and one that investors should not be making. One of these bad periods can deliver a big blow to your investments, and that's why we are amending Step 6 in the SEC's investing roadmap. To get on the road to worry-free investing, follow this new improved Step 6. The first thing you should invest in is Series I savings bond, shown below in paper form. Fortunately, now in the digital age, it is much easier to purchase and keep track of your I bonds. Follow Uncle Svi to find out how.
You can start building your savings with digital savings bonds by setting up a Treasury Direct account. If you have children under the age of 18, you can open a minor account for them within your own Treasury Direct account. Savings bonds can be bought in your child's name by you, relatives, or family friends. Once you've established your account, you can buy a digital savings bond in a few simple steps. First, go to the Buy Direct page. Next, you'll enter the following information: the type of savings bond you want, either Series I or Series EE, the name of the person who will own the bond, the amount you want to buy, which account to use for your purchase, such as your bank checking or savings account. To finish buying your digital savings bond, submit your purchase request and print the confirmation page for your records. To acquire more digital savings bonds, to manage your account, or to redeem your savings bonds, simply log into your Treasury Direct account, which is accessible online 24/7. The Treasury Department's all-electronic process eliminates any trips to the bank and the risk of misplacing or forgetting about your savings bonds or any savings bonds in your child's name. For more information on digital savings bonds, go to the Treasury Department's Ready Save Grow website, treasurydirect.gov/ReadySaveGrow.
In another video, we'll show you the many ways you can use I-bonds, and we'll even include some tricks to help you out. But the first thing to do is use I-bonds to create an emergency fund. By making this safety net, we can get back on board and follow the SEC on their roadmap. So let's follow to Step 7. Now that investing in I-bonds is Step 6, investing the way the SEC described before now becomes Step 7. But we want to make a very, very important distinction here. Investing in stocks and bonds are risky assets, unlike in Step 6 where I-bonds are for all considerations risk-free. If you have money that you don't mind risking, we're not saying don't. In fact, we'll even help you in another video. But we want to make sure is that if these assets don't always increase and start to fall, that you have a safety net to catch you. And it's all thanks to I-bonds. At Uncle Svi Says, we think the missing link to most investment advice is I-bonds. So let's change the minds of the investment industry right here, right now. Since most investors think like Investopedia, let's take a look at what they say about I-bonds. Because these securities are so safe, they offer an extremely low rate of return. For most investors, inflation index securities simply don't make sense. So to fix this, all we have to do is cross this out, and then we can move this over, because not only do I-bonds make sense, but scientifically, they should be your starting point when investing, because, as Investopedia said, they are so safe. Now it's your turn to take a trip along the road to worry-free investing, and the directions are very simple. Just follow the SEC and go to investor.gov to see their roadmap to investing. Just remember that you should invest in I-bonds before you ever think about investing in risky assets. That's it for this edition of Uncle Svi Says. We hope you enjoyed, and as always, we hope you learned something.